My dear students, welcome back to our channel. In this video, I will be explaining the Bcom 5th semester subject Business Economics as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 5 first important short question is Concept of Total Fixed Cost, TFC. Meaning, total fixed cost, TFC, is the part of total cost that does not change with the level of production. In simple words, it is the cost a business has to pay even if it produces nothing. Key points. TFC remains constant in the short run. It is independent of output. Examples include rent of factory, salaries of permanent staff, insurance, and machinery depreciation. Example. Imagine a small bakery renting a shop for 10,000 rupee per month. Whether the bakery produces 0, 100, or 500 cakes, the rent, 10,000 rupees, remains the same. Similarly, the salary of permanent staff like the manager does not change with production. Importance. Helps firms plan costs and understand how total cost is structured. When combined with variable costs, it gives total cost is equal to TFC plus TVC. Easy trick to remember. Fixed cost is equal to pay even if you don't produce. Variable cost is equal to pay only when you produce. In short, TFC is the constant backbone of total cost that does not depend on how much you produce. Next important short question is 2 explicit costs. Explicit costs. Meaning, explicit costs are actual payments made by a firm to buy resources or services used in production. These are out-of-pocket expenses that can be easily recorded in money terms. Key points. They involve direct cash payments. Include costs of raw materials, wages, rent, electricity, and machinery. Part of accounting costs of a business. Example. Suppose a tailor is making clothes. 5,000 rupees spent on cloth. 2,000 rupees paid as wages to helpers. 1,000 rupee rent for shop. All these are explicit costs because the money is actually paid. Importance. Helps firms calculate total production cost. Used in profit calculation. Accounting profit is equal to total revenue explicit costs. Easy trick to remember. Explicit costs is equal to money outflow you can see in your bills. In short, explicit costs are the visible, real expenses a business pays to produce goods or services. Next important short is 3 implicit cost. Meaning, implicit costs are the hidden or not directly paid costs of using the owner's own resources in production. In simple words, it is the income a business owner forgoes by using resources themselves instead of renting, selling, or investing them elsewhere. Key points. No cash payment is involved. It is an opportunity cost of using own resources. Included in economic cost but not in accounting cost. Example. Suppose a person runs a small shop in their own building. They could have rented the shop for 10,000 rupees per month. By using it themselves, they forgo 10,000 rupees, which is an implicit cost. Similarly, if the owner works in the shop instead of a job paying 20,000 rupees per month, that salary is also an implicit cost. Importance. Helps calculate economic profit. Economic profit is equal to total revenue explicit plus implicit costs. Easy trick to remember. Implicit cost is equal to the money you could have earned but didn't. In short, implicit costs are hidden costs of using your own resources in business. Next important short is 4 opportunity costs. Meaning, opportunity cost is the value of the next best alternative that you give up when making a choice. In simple words, it is what you sacrifice when you choose one option over another. Key points. It is not a cash payment but a lost benefit. Helps in making better business decisions. Used in both economic and managerial decisions. Example. Suppose you own a plot of land. You have two options. 1. Build a shop and earn 50,000 rupees per year. 2. Rent it out for 60,000 rupees per year. If you choose to build a shop, the opportunity cost is 60,000 rupees, the rent you gave up. Importance. Helps firms decide the most profitable use of resources. Ensures resources are used efficiently. Easy trick to remember. Opportunity cost is equal to what you miss out on when you choose something. In short, opportunity cost is the value of the next best alternative you forego when making a decision. Next important short is 5. Long run cost, LRC. Meaning, long run cost refers to the total cost of production when all inputs are variable. In the long run, a firm can change the size of its factory, machinery, and labor. Unlike the short run, there are no fixed costs in the long run. Key points. All inputs are adjustable. Helps firms plan for future expansion. Includes costs of labor, raw materials, machinery, and new plants. Example. Suppose a small factory produces 1,000 chairs. In the short run, it cannot expand space. In the long run, it can buy a bigger factory and hire more workers to produce 5,000 chairs efficiently. The total cost involved in this expansion is the long-run cost. Importance. Helps in long-term planning and investment decisions. Determines the optimal scale of production for maximum profit. Easy trick to remember. Long run is equal to no fixed costs. Everything can change to produce more efficiently. In short, long run cost is the cost when a firm can adjust all resources to produce goods efficiently. Next unit 5. Long questions. First important long question is: explain the short run total and average cost curves with the help of table and diagrams. Short run total and average cost curves. Meaning, in the short run, at least one factor of production is fixed, like machinery or rent, while others, like labor or raw materials, are variable. Costs in the short run are divided into 1. Total fixed cost, TFC does not change with output, example, rent, salaries. 2. Total variable cost, TVC changes with output, example, raw materials, wages. 3. Total cost, TC sum of TFC and TVC. TC is equal to TFC plus TVC. Average costs. Average fixed cost, AFC, is equal to TFC output always falls as output increases. Average variable cost, AVC, is equal to TVC output usually U-shaped due to initial increasing efficiency and later diminishing returns. Average total cost, ATC, is equal to TC output is equal to AFC plus AVC also U-shaped, lying above AVC. Illustrative table. Output TFC, TVC, TC, AFC, AVC, ATC. 0 100 0 100. 10 150 150 10 5 15. 20 190 195 4.59.5. 30 100 150 253.335 8.33. Graph explanation. AFC curve, continuously downward sloping. AVC curve, U-shaped, falls first, increasing returns, then rises, diminishing returns. ATC curve, U-shaped, always above AVC, falls due to spreading of AFC and rises later due to rising AVC. TC curve rises as output increases, slope increases after a point due to higher variable costs. Example: a bakery has fixed rent 100 rupees per day. It buys ingredients and pays wages, variable cost, depending on the number of cakes produced. As production rises, TC rises, AFC falls, AVC first falls then rises, ATC is U-shaped. Easy trick to remember. Fixed costs stay, variable costs move, averages form AU in short run. TC rises, ATC is equal to AFC plus AVC dot. In short, short-run cost curves visually show how costs change with output and help firms make production decisions efficiently. Next important long question is to explain the short-run cost curves with the suitable diagrams. Short-run cost curves. Meaning, in the short run, some resources are fixed, like land, machinery, while others are variable, like labor and raw materials. Costs in this period are categorized as fixed, variable, total, and average costs, which help firms understand how costs change with output. Types of short-run cost curves. 1. Total cost curves. Total fixed cost, TFC constant, horizontal line, does not change with output. Total variable cost, TVC rises with output, slope increases after a point due to diminishing returns. Total cost, TC sum of TFC plus TVC, rises as output increases. 2. Average cost curves. Average fixed cost, AFC is equal to TFC output always declines as output rises. Average variable cost, AVC is equal to TVC output U-shaped, falls initially due to better efficiency, then rises due to diminishing returns. Average total cost, ATC is equal to TC output is equal to AFC plus AVC U-shaped, lies above AVC. 3. Marginal cost curve, MC. Additional cost of producing one more unit. MC curve is U-shaped and intersects both AVC and ATC at their minimum points. Example: a small textile unit has rent 5,000 rupees per month, fixed. Labor and raw materials cost varies with the number of shirts produced. As output increases, TC rises, AFC falls continuously, AVC first falls then rises, ATC forms a U-shape, and MC intersects AVC and ATC at their lowest points. Diagram explanation. AFC continuously declines. AVC and ATC U-shaped. MC U-shaped cuts AVC and ATC at their minimum. TC rises continuously with output. Easy trick to remember. Fixed costs stay flat, variable costs rise, averages make U-shape, marginal cuts the U at bottom. In short, short-run cost curves help firms decide output levels and understand cost behavior for better production planning. Next important long question is 3. Explain the various short-run cost curves. Explain the relationship between average cost and marginal cost. Short-run cost curves and relationship between AC and MC. Meaning, in the short run, at least one factor is fixed, like land or machinery, while others are variable, like labor or raw materials. Costs are classified into 1. Total cost, TC sum of fixed and variable costs. TC is equal to TFC plus TVC. 2. Fixed cost, TFC does not change with output, example, rent. 3. Variable cost, TVC changes with output, example, raw materials, wages. 4. Average cost, AC cost per unit. AFC is equal to TFCQ falls as output rises. AVC is equal to TVCQ U-shaped. ATC is equal to TCQ is equal to AFC plus AVC U-shaped, lies above AVC. 5. Marginal cost, MC extra cost of producing one more unit, U-shaped due to increasing then diminishing returns. Relationship between AC and MC. When MC AC, AC falls. When MC AC, AC rises. When MC is equal to AC, AC is at minimum. This is like grades in school. If a new mark is higher than your average rises. If lower, average falls. Example. A small bakery has fixed rent 100 rupees per day. Ingredients and labor cost rise with number of cakes. TC rises with output. AFC falls, AVC falls then rises, ATC is U-shaped. MC intersects AVC and ATC at their minimum points. Easy trick to remember. MC pulls AC, if MC below AC, AC falls, if MC above AC, AC rises, MC meets AC at minimum. Diagram explanation. AFC continuously declines. AVC and ATC U-shaped. MC U-shaped intersects AVC and ATC at their lowest points. TC rises steadily with output. In short, short-run cost curves show how costs behave with output, and understanding MC-AC relationship helps firms make production decisions efficiently. Next important long question is: 4. What is break-even point? Illustrate how to find out the break-even point with the help of an chart example. Break-even point, BP, in business economics. Meaning, the break-even point, BP, is the level of output where total revenue, TR, equals total cost, TC. At this point, the firm neither earns profit nor incurs loss. It is very important for firms to know the minimum output needed to cover costs. Formula: BP units is equal to fixed cost, FC, selling price per unit, P, variable cost per unit, VC. Explanation: fixed costs, FC costs that don't change with output, example, rent, salaries. Variable costs, VC costs that increase with output, example, raw materials. Selling price, P price at which the product is sold. Example. A toy factory has FC is equal to 10,000 rupees. VC per toy is equal to 50 rupees. Selling price per toy is equal to 150 rupees. BP is equal to 10, 000, 150 to 50 is equal to 10, 000/100 is equal to 100 toys. So, the firm needs to sell 100 toys to cover all costs. Selling more than 100 gives profit, less than 100 gives loss. Break-even chart explanation. X-axis, output, units. Y-axis, cost revenue. Fixed cost line, FC horizontal, constant. Total cost line, TC starts at FC, rises with output. Total revenue line, TR starts at origin, rises with selling price per unit. BP, point where TR line intersects TC line. Uses of BP. Helps in planning production. Assists in pricing decisions. Helps in risk analysis, profit-loss zone. Easy trick to remember. Break-even means break-even cost is equal to revenue, sell enough to cover fixed plus variable costs. In short, BP is a simple but powerful tool for business planning, showing the minimum output required to avoid loss. Next important long question is: 5. Explain the uses and limitations of break-even analysis. Uses and limitations of break-even analysis, BP. Meaning: Break-even analysis helps a firm understand the minimum level of output required to cover costs. It is widely used for planning, decision-making, and risk management. Uses of break-even analysis. 1. Determining minimum output. BEP tells the exact number of units a firm must sell to avoid loss. Example, a juice shop needs to sell 200 bottles per month to cover rent, wages, and ingredients. 2. Pricing decisions. Helps decide selling price to cover costs and earn profit. Example, if selling price is too low, BEP increases, if high, profit is easier. 3. Profit planning. Shows how profit or loss changes with output and costs. Example, selling to 50 bottles gives profit, selling 150 gives loss. 4. Cost control. Helps identify high fixed or variable costs that affect BEP. 5. Investment decisions. Guides whether a new project is viable based on BEP and expected sales. Limitations of break-even analysis. 1. Simplistic assumptions. Assumes costs can be clearly divided into fixed and variable, which may not be true in real life. 2. Constant price assumption. Assumes selling price per unit is fixed, ignoring discounts or market fluctuations. 3. Ignores market conditions. Does not consider competition, demand changes, or economic conditions. 4. Single product limitation. Works best for single product firms, becomes complex for multiple products. 5. Short-run focus. Mainly useful for short-term decisions, not for long-term planning. Easy trick to remember. Use BEP to plan and price, but don't forget reality, costs, prices, and demand can change. In short, BEP is a practical tool for planning, pricing, and cost management, but it has limitations due to its simple assumptions and short-run focus.